So our panel members today are Peter Hannam, Director in Asset Management Infrastructure at IFM Investors, Esther Kerr-Smith, Chief Executive Officer, Wealth and Capital Markets, Australian Unity, and Nguyen, Executive Director, Infrastructure Delivery, Victoria, Department of Treasury and Finance. So welcome all. So this session is looking at the role of investment in shaping the planning, delivery and use of infrastructure assets, and its focus in particular is on how investment can help to reimagine multi-stakeholder partnerships to deliver economic and social benefits. And we've had now, I think, over 20 years, and you'll be able to tell us the precise date on which Victoria introduced the Partnerships Victoria policy, but I think we've had more than 20 years of experience with governments and the private sector working together to deliver infrastructure assets. And we're very fortunate to have three panellists today in Peter, Esther and Anne who can draw on that experience and help us to reimagine the future. So there's a lot of ground to cover and we'll get straight into the discussion, but just a reminder that please do send through questions for the panel. Now, Esther and Peter, if I can start with you. You both have responsibility for large infrastructure investment portfolios. Can you tell us what are the economic and social factors that make an asset an attractive investment for your organisations? Peter, perhaps you can lead us off.
I think from IFM's point of view, we are typically a core infrastructure manager, so the things that we're looking for won't be unsurprising to the audience here, but assets with strong GDP linkage so that we can forecast in reasonable accuracy as their potential growth options. We like assets with CPI-style pricing regimes, so contractual pricing regimes where CPI pricing can be passed through. We really like assets with some kind of contractual or physical characteristic that gives it a dominant competitive advantage in whatever market that it's playing with. And then most importantly, I think we want assets that have the capacity to grow, and so the ability to further invest capital, whether that be equity or whether that be the debt from the underlying portfolio assets, into those businesses so they can meet demand growth over a long-term journey is really important to us. And one of the things we've been thinking about lately is, well, what social licence do you need to facilitate that growth? Because in the world of permitting and environmental concerns, the ability for major capital projects to be developed is becoming a little bit harder and harder and harder. So social licence is really, really important to us. And so when we look at the portfolio, and I look after the asset management side of things, we really want to know how the assets are treating their employees, especially as we're going through transitional or transformative times, and we think principles around just transition are really, really important. We want to know how the assets are working with their local communities and the grants and the way that they sponsor activities that communities care about. But most importantly, we really want to know how the assets are treating their customers. Are they running their own businesses in the way that their customers expect? And if we can do all those, that really starts to give you a reasonably strong social licence, which allows us to deploy capital in the way that both of our investors expect us to do and the way that we want to do. And one of the things we've been sort of thinking about, and I know you spoke about sort of social infrastructure earlier, is how do we get involved in affordable housing and different sectors that we don't have much of involvement in. We do own some schools through PPPs, and we own law courts in Perth through a PPP, and historically we've owned aged care homes as well. But the issue we bump into is scale, and I think for the major infrastructure funds, there are certain segments that become hard to invest in if you either don't have scale initially or can't create that scale through growth. So we're just trying to work out at the moment, well, how do we create potentially different infrastructure classes like social infrastructure that others would be probably a better place to speak about. But for us, it's about if we can get the social licence right and we can think about scale, then that starts to meet some of the fundamentals around, well, what does a good infrastructure asset look like?
Esther?
So we, at Australian Unity, our purpose is to help Australians thrive. And we start there, and that tells us where we invest our time, our capital, our energy, our ideas. And so our North Star, if you like, is to put our investment into the infrastructure that we have conviction will have the most positive impact on the well-being of the communities that we service and live in. We measure that first and foremost through the community and social value that we attribute to an investment in an asset. So we start with our understanding of wellbeing, which we've been measuring for 23 years, and we measure the potential community and social value of a social infrastructure asset. And then if we think that we can make a difference in a positive way, then that's where we're going to try and make the investment case stack up behind the social impact case, if you like. Agree with Peter, the subscale nature and the nascent nature of the regulation and the pricing around some of the social infrastructure assets that we care about makes them the poor cousin often of core infrastructure. They're not, the ticket sizes are not big enough, and the returns, risk-adjusted returns, are not certain enough for the sort of debt packages and the big funds to get interested in. So where we have been playing and investing our time is at that sort of nascent, emerging social infrastructure asset classes, where we're trying to bring like-minded people, bring operators into partnerships early, because they're key to realising or not realising value in a social infrastructure asset over its life. And then build the scale. So first in the Australian Unity portfolio is the now seemingly obvious overnight success of the Healthcare Property Trust, but I was informed that 20 years ago we had $40 million of assets, and it was also a sort of very far left field alternative asset class that no one understood and people didn't trust, and now it's one of the highest returning and hotly contested sort of real estate, real assets asset classes in Australia. So there's future for bringing forth and making investable and institutionalising the investment into some of the social infrastructure that we need, and that's where it's attractive, and that's where our imperative is.
Right, and I'm interested to know to what extent you said is important, and and to what extent it's the case that those social benefit factors form part of the investment mandate. Is that something which is part of the vision of the organisation?
Yes.
Yes.
Yeah. So I think Australian Unity, when it started, it was probably more easily connected to the community that it was trying to solve. So the mandate of addressing the community's most pressing challenges was easier to do organically. Now that we're bigger and we're national, and the problems are complex and larger, and we have a professional management team, we asked ourselves the question some years ago of how do we hold ourselves accountable to our members and our community that we are in fact delivering value and not just filling our own pockets and making ourselves feel good as we go along. And for that reason, we developed our community and social value impact measurement framework, which is attributing, it measures the value of the activities in our portfolio. It applies an attribution over the top of that so that we don't take credit for everything. And then we measure it and we track it and we report it. And that's in all of our business cases now when we're deciding where to put more of our capital or investors' capital. And it's also reported annually so that we can demonstrate and provide that assurance that we're improving and making the right choices as we go along.
Peter, is there anything you wanted to add to that?
I guess it's similar. I mean, our sole objective is to deliver, fantastic returns for our investors. That's what we get up in the morning to do. Now, the definition of fantastic returns is different slightly for each investor, but survey after survey that we've done has shown that it is the financial return that really drives their interest in our products. That's beginning to change. I've been at IFM for about 7 years now, and when I started, terms around ESG and things like that, we really didn't discuss them. Now it takes up a significant portion of the way that we think about both our existing assets and our future investments. So we can absolutely see the social and ESG side coming very much into it, but But the trustees that invest in our products and ourselves, we have to deliver great financial returns as the absolute priority for our business.
Yeah. And turning to a government perspective, I think it was Annabelle who made the comment this morning, you may not have been here, but that the Victorian government and Victorian Treasury has been a leader in partnerships between public sector and private sector investing in infrastructure. How do you see, or does Victoria have a different approach, do you think, to other jurisdictions in the way that it ensures its PPP projects in particular are delivering the sort of social outcomes that are being sought?
Yes, thanks. It's very pleasing to hear both Peter and Esther speak about your objectives in investing, particularly public infrastructure. It just demonstrates sort of the trend towards this, or the recognition that economic outcome and social outcome are pretty much interwoven nowadays, and that in getting the return to your shareholder, you talk about social license, and Esther, you talk about investing because there's a social needs. From a government perspective, I just want to highlight that obviously Victoria utilises a very comprehensive business case sort of process, and that process seeks to identify the gap or the problem to a service needs, and then identify what would be enabling assets and or changes that will be required, and therefore what sort of service benefits will be delivered to the community through the investment in that solution. And all of those parameters are then sort of form part of the project objectives or investment objectives that will then inform and shape the procurement model as well as the contract specifications. So that's sort of the basis for which we will undertake investment from a government perspective. Obviously, PPP is uniquely positioned to align that long-term investment objectives because of its long-term and whole-of-life nature. And as a result, from a government perspective, I'd say this: not every project will be suitable for PPP. So that's sort of just obvious. But for the right projects, the PPP model is capable of and has demonstrated that's delivered far superior outcome compared to the alternatives. And the way that I think Victoria has done really well is that sort of very solid baseline that we've had over the last 20 years, but also our ability to be agile and move with the time. There's that continuous improvement process that we've got in place through a really close engagement with the market. Esther, we've had conversations about the next evolution of how do we use sort of the principles of PPP to look at some of the more pre-sync outcomes, both delivering social outcomes but also having an element of private sector returns. Beyond that, closely engagement with the market will also help us identify opportunities that potentially might not be originated from the public sector. We do recognise that good ideas are coming from all sort of places, we've got the market-led proposal process in place where private sector can bring good ideas to government, and all of those processes provide a level of confidence in engaging with the government, and from our perspective, that's sort of delivering the outcome.
Right, there's a question from the audience which I think follows on nicely from that. It says, while investment from private capital may be welcome to governments, are there classes of infrastructure that governments should not allow the private sector to control. And I think there's probably a related question, which is, are there areas where really governments should leave it to the private sector to invest? Perhaps we'll start with you, Anne, but I think you all may have a comment on that.
Yes, so I think I don't believe that there are absolutes in everything. The fundamental principle is that we, as government, shouldn't interfere in the market where there's a vibrant and commercially and economically viable market in place. The role of government is to facilitate, when there is a gap or market failure, or where there are, investments that potentially might not provide an economic return to the private sector, and that's the role of government. Hence, a lot of our investments are in that sort of social infrastructure space. But by the same token, there are an element of broader and long-term strategic objectives and visions that the government needs to take into account. Issues such as, security, security of supply, also, facilitating future reforms, and things like that will come into play. So I wouldn't say that there would be, an absolute no or yes in any of the classes of the infrastructure, but the overarching principles is that we don't interfere when it's working well, and there's plenty of private capital in place, and also, intervening wouldn't sort of provide any additional benefits from a social outcome perspective.
Any comments, Peter or Esther?
No, I mean, I think that there's always different models, and I think it maybe to Anne's point, it's not necessarily about the asset class, but there's always a way to put a regulatory overlay on top of private ownership that ensures that that asset or that infrastructure asset is being run in the way that the community expects. And from an IFM's point of view, that is a completely irrational way to approach things, and that's something, as I mentioned, the social licence we were absolutely cognizant of. I'm not sure if there are assets that are better than other assets, but I think probably the great story, if you look at the Australian airports, say, market at the moment, you try travelling through regional United States and seeing sort of airports owned by local councils, local state authorities, that has proven not to be a great model for those particular characteristics. So there's assets where continual investment is required. We tend to think might be a better place to sit in the private side of things, but that's only on the condition that those owners or those investors are ready for that long-term view. I think if you look at the UK water market, where, again, there's nothing overtly special about water, but the regulatory overlays on some of those privatisations probably haven't worked in the way that the community expected, and as a result there's been a significant amount of angst as to private ownership of water assets, specifically in the UK. So I think it's a matter of getting the balance right between what is the regulatory overlay and how can that be enforced, and then where can private capital play a role, especially for those asset classes that need continual investment.
Totally agree with Peter on the vast majority of core infrastructure projects. It's overly simplistic and inefficient to just have it must be entirely owned by government, or it can't be, just because it's important or just because it's large. Or if you get the regulation right, you get the best of both worlds. You can get private sector innovation, new technologies, new investment, and still protect the access, the accessibility and the equitable access for the constituents that are using the important infrastructure. So airports, great example. In social infrastructure, I feel like if the government had the balance sheet and the capacity to invest what is needed and to keep it up and to maintain it, and they said we want to do it because it's very sensitive, no problem. The problem is they don't, and they haven't been. So it's a false choice to say at the moment keep private capital out of out of social infrastructure because then there'll be no capital in it. So the challenge is the other way around, is how do you safely make it safe and secure and underwrite and invite back in private capital into some of the social infrastructure opportunities. And the irony is that the taxpayer and the government is not the only representative of community assets and investable assets. So are the industry super funds, so are member-owned organisations such as Australian Unity. So what is wrong with the community owning its own community infrastructure? This kind of private-public question is very unhelpful, I think.
Yeah, I mean, I think the point you made about getting the regulation right is the critical one. It's always seemed to me that that's the most important issue. If you can get the governance and the regulation right, then that's the basis upon which you can combine private and public participation. We also heard this morning, I think it's a related point, about the importance of going slow early in the process with project planning and development to get a very clear understanding and agreement across the public and private sector of what the objectives are. So this is a question I think you may all have a view on. So given that the long-term goals are generally not woven into the terms of infrastructure projects, would projects benefit from more first-stage consultation to discuss the desired social outcomes and how to measure and achieve them?
100%. I forget who said go slow to go faster earlier today, but completely agree. And Anne is also right, and the wisdom that the Victorian government is bringing forth here in understanding that the starting question should be what problem we're trying to solve. And then it's not necessarily infrastructure, or it's not necessarily real assets. Maybe it's a combination of operations, logistics, workforce, technology, and a building here and there. So if the government understands that it puts that question to the market, this is the problem we're trying to solve, the challenge we're meeting, what are your ideas, almost agnostic to the kind of input combinations of infrastructure or otherwise, you will get the more comprehensive response, the more innovative response, and the more efficient and value for money response straight up. So upfront, yes. A plug for a procurement model that we've shared with Anne, that Australian Unity has participated in Queensland, is a sort of an innovative new PPP, a partnership arrangement over 99 years, where earlier today we heard from multiple speakers, including the Minister. Resilience is important. COVID showed us that we didn't have the contingency in our infrastructure system, the resilience to deal with the unexpected things, the flexibility to change our mind, the flexibility to introduce new technologies if they're moving fast. So even if you do the absolute best job of consulting private sector upfront, and everyone upfront, community and everyone, you get the best possible holistic solution response. These things take 4 or 5 years to get out of the ground, minimum. Some things have changed by then. So what else can you introduce into the procurement model that creates alignment, that allows government to change its mind about some things or move an asset around within a precinct? That's why one of the reasons we like precincts is just conceiving of an area that needs to house 3 or 4 different types of social infrastructure, but not predetermining and pre-commissioning all of them up front, and giving yourself the flexibility and the capacity to flex with demands as it goes along. So yes, up front, and yes, through the life, if you're bold enough to extend your procurement model in that way.
Peter?
I agree with everything that Esther says. I think that especially with long-term infrastructure, that probably is where maybe traditional models in that PP world start to become somewhat constrained. And I'm sure people have talked about energy transition this morning, and we'll talk about it later on. But we're thinking of changing all the energy inputs should be green at the moment. But it is cheaper to buy black power at the moment. So how do you bring that into a construct for a contract that was struck sort of 20 years ago? It can be quite difficult to bring that type of change. Now, maybe no one predicted that. Maybe someone should have predicted that. But that flexibility around site-based master planning, where you know that you've got continuation of ownership over a very long term, and you can continue to invest in a flexible environment, probably doesn't fit into some of the more traditional models. And I don't know what the answer necessarily is, but rigidity is obviously the opposite of flexibility, so depends what you want.
Yeah. Okay, I've got a couple of quite specific questions for Peter and Esther about some of your investments, but I'll get to those in a second. I just wanted to go back to Hannam. Esther made the comment about a very good model which had been adopted in Queensland, and again we heard in an earlier session this morning about how often you do identify very good and effective models in a particular jurisdiction, but it's often difficult, or we don't often observe that model being picked up and adopted in another jurisdiction. I'm interested to know whether you think there's more that can be done within government at collaborating between jurisdictions in order to get those best practice models. And my own observation about it is that I think often it's the advisors to governments who tend to bring those models across jurisdictional boundaries a bit more than the departments and agencies themselves, but you may have a different view.
Yeah, you'd be surprised to know that we do talk quite a fair bit. Yes, over the last decade or so, there's been a concerted effort between different governments, both federal and state, and across the different jurisdictions in Australia to be a lot more joined up. We do recognise, particularly in the infrastructure space, we're dealing with the same parties or counterparties on the other side. And as you say, a lot of the projects will have similar characteristics or issues or benefits or opportunities that can be shared across different jurisdictions, and we do talk to each other about those. One thing that is potentially not seen from outside is that we do have certain constraints working within government, and sometimes, ultimately the public service can provide advice, but decisions are made at a government level. So that being said, I think we've done a lot better over the last decade or so. The evidence is, as you very rightly pointed out, Victoria was one of the very first jurisdictions in Australia to have developed a very comprehensive PPP framework back in the early 2000s. That framework subsequently was adopted across the nation as the national PPP guidelines. I'm very pleased to say also that over the years we've had numerous requests across the globe for the use of our framework, guidance materials, practice notes and templates. We've made a concerted effort to standardise a lot of our processes, as well as contractual documentations. Just lately, New South Wales Treasury and ourselves have come together to harmonise our PPP or standard PPP deeds. Hopefully, a lot of you have been consulted throughout the process, and hopefully that can be released for use both in New South Wales and Victoria following the New South Wales election. So there's sort of a lot of incremental steps that have been taken from a government perspective. And coming back to the engage early and go slow, that's always been, from our perspective, the more planning and development, and the more understanding and clarity we can get up front. From the government perspective as well, what is it that we're buying? What is it that we're wanting? If we don't know ourselves it's difficult to then articulate and communicate to the market what it is that we want to achieve. So again, that's always been the aim for us, but we also need to acknowledge and recognise that we live in an environment where the communities and the voters are very, very impatient, more and more so. So there is a tension in between, an ability to demonstrate and sort of immediate outcomes and action vis-a-vis, taking time to really plan and develop an investment before it actually go into market.
Thanks, Anne. Now this question is right at the top of the leaderboard, so I've got to ask it next. Is social housing likely to generate sufficient returns to generate investor interest? Peter.
We have signed up to the sort of National Housing Accord, so IFM has committed to go back to the federal government with ideas around how to exactly meet that challenge. I mentioned earlier that we absolutely have a fiduciary duty, and the trustees have a fiduciary duty to make sure that returns that we invest in meet a mandate. We have a fund that has a mandated return level, and we have to invest in projects that, in theory, meet that return level. I think that's going to require a little bit of different thinking. I think maybe there is the option for sort of more market-led proposals to come forward. Maybe that's sort of part of the answer. I think ultimately there's going to have to be considerations about the ecosystem of social housing and how do you monetise that ecosystem. We know that if we can provide shelter from someone who's the victim of domestic violence, there's actually huge financial benefits to getting them out of that situation in terms of not only medical but social and mental health issues. So there's going to have to be some kind of jump potentially to monetise those externalities, as you would refer to them, and sort of from an economist point of view. That's part of it, and I do need to come back to that question around scale that I addressed earlier, and it probably depends on the types of funds and who you're speaking to, but once you're getting funds that are sort of in multiple $10 billion style funds at the moment, how do they invest in scale that gives them the portfolio diversification effect that they need to warrant the difficulty of investing and then managing that investment on an ongoing basis? Now, we know the scale and the challenge is there, but it's quite discrete in terms of each individual location. So you're going to have to think about a really long runway of projects that can be put forward, and there needs to be sort of contractual overlays that can last a reasonable amount of time to get that scale of investment required. And that's probably speaking more from our point of view, which is what we sort of think about. But those are the challenges that we can sort of see. But there is absolutely, I think, a pool of capital that's ready to go. It's just a matter of getting the right construct and getting acknowledgement potentially of the problem and the benefits that solving the problem creates before you'll really get traction, I think. But it's something that we're working on. We've got consultants working on at the moment as different models that we can put forward to the government that would, that certainly from IFM's point of view and potentially the wider industry fund sort of grouping would be attractive to us.
So do you have any comments?
I think the returns cumulatively from getting every Australian into a home are massive. They're definitely there. Peter's right. It's who they're accruing to and how we capture them, so that we can recognise them, value, and invest against them. The long-term benefit to the government budget of having retirees in homes, avoiding homelessness, reducing pension requirements, reducing aged care appropriations, reducing the business case is easy if you lift yourself all the way up and just say what are the returns from people having stable housing. Economic participation, in particular from women, you would just turn this economy on if the single biggest constraint in the Australian economy at the moment is workforce. How do you get more out of the people? And migration will come, but it'll take its time. How do you get everything, the infrastructure and housing should be pointed at unlocking our workforce. How do you get them to be closer to their work, higher utilisation, higher participation, greater engagement, and greater longevity in their jobs? There's your productivity and there's your business case. So it's there, but it's in a user pay system that is what IFM and others investors have to invest against. It's not meeting the risk return hurdle against regular residential real estate or an infrastructure class. It doesn't have the regulation that will give it an infrastructure type return. The way we are thinking about it is there's a lot of people thinking about it and there's a lot of people with their hand out. So how can we be creative at Australian Unity for some cohorts where we can see the value of some of those externalities and maybe use them to fund more housing? For example, we have 4,000 care workers. Those care workers, we have a lot of churn. They're ageing, they're mostly middle-aged women. They're financially less secure than we would want them to be. And yet we have a brand new aged care facility on the Mornington Peninsula with two of the households closed because we can't get care workers. So we are incentivised, not just because we're nice people and not just because we're looking for a return on housing, but to find affordable, stable houses for our care workers which is close to their employment, and therefore we get use out of the infrastructure, we get less churn, we pay less agency, we do less training. So the leakage in the system, I think if we can catch it, we can easily afford to put more social housing and affordable housing out there. It's just who's getting the benefits and how do we expand the perimeter of the business case so that we can be systematic and have a systems view of it.
And really, I think it's about how you get those social and economic benefits into an investment return that can support the investment.
Yeah, and I think the big super funds are going to say it's either a real estate asset, in which case, how do I better understand the credit and what is the rental return for the risk, or it's an infrastructure asset, and then I need to be able to leverage it. And for me to be able to leverage it, I need a big portfolio and I need some clarity and some certainty of the regulated nature of the cash flows that are going to come back. Doesn't mean the government has to pay all the rent. It just means give me my 6% or give me my 7%, whatever it is, and I know it's there, and then I can gear it up and roll it out. I mean, that's your job, not mine. But
I agree. My view is that there is enormous scope for partnership between government and the private sector in the housing space. Particularly if you look at, just taking Victoria, for example, the ageing assets, and most of them are not fit for purpose anymore, given that, the changing nature of our clients, our social and affordable housing clients, but there's also an emerging class of what we call essential workers houses that we need to provide. Most of you will be aware that we've undertaken the first ground lease model project with Homes Victoria. The second one is in tender at the moment. The ambitions there is really finding, so these are sort of pathfinding models, but we want to get to a point where there is a sustainable long-term model whereby we provide sort of certainty and clarity to the market as to what needs to get done over a long-term or long period of time, and what's available from the government perspective. Is it land? Is it sites, money, and how then we can partner with the private sector to achieve these sort of targets that we need to meet, because if we continue to deliver those housing on balance sheet, we won't be able to.
Okay, a related question from the audience, which is specifically addressed to you, Peter. I think you've probably covered a bit of it, but I'll ask it. So you mentioned that IFM has a greater focus on ESG these days. How will IFM invest differently to ensure it's meeting the S in ISG? Are there any particular asset classes of interest?
So probably the S in the last 2 to 3 years has been a little bit of a poor cousin of the E, and I'm reasonably confident on the G. But we've just brought on our first dedicated S resource in our ESG team, and we're very, very focused on the issues that S is creating both internally within our assets, and that's, particularly around the contractor side of things. The operating model for most of our assets is what I would call an outsource style model, but really being clear on the contractual relationships that our assets have with their contractors and how that marries into topics around S and pay and treatment, access to the rights that potentially permanent employees have. That's been a big area of focus. Somewhat topically, I think this year, but from an ongoing basis, we've got a very large focus happening in relation to our treatment and our involvement in First Nation issues, and we read the paper yesterday about the announcement around the voice. That's something that we are increasingly wanting to understand, and that our shareholders increasingly want to understand, our investors and our shareholders, I should say, are increasingly want to understand our relationship with First Nations people. And it's quite interesting, we have investments located all over the world, but the principles that we're developing here and how they're translating to our assets in Canada and United States of America that actually have some similar situations in relation to First Nations people is really important. Probably the biggest change has been the way that we treat S in the due diligence stage of transactions now. So I talked about the concepts around social license in my first answer. But that is now getting significantly more attention, in our investment committees when we're bringing papers forward, ideas forward around potential deployment opportunities. Lots of questions relating to how does the S work and how are we going to manage, particularly the issues in relation to S in transformational style assets, where we do need to take assets that have been operated, per a particular operating model, and we want to see a different operating model impacted for the benefit of the customers and the consumers of that asset. Those principles around just transition and how we think about them, whether that be automation at a port, are very, very much becoming front of mind as the S sort of increases in prominence as compared to the E, which we've really been focused on the last few years.
Yeah. Okay, we're just about out of time, but just one more question for a quick response from each of you. So I think we see the different cycles of infrastructure investment. Sometimes it's very much a focus on the big new projects. At other times it's a focus on delivering existing projects and managing the operation of existing projects. So in the current environment, would you say the ideal role for a future-minded investor is to direct capital towards the imminent challenges of the energy transition, population growth, the ageing population, technological change, or is it to focus on shepherding existing projects to completion and in the right direction? Esther?
I think after a few years of very heavy weighting in Victoria, very heavy weighting of infrastructure investment it's gone into transport, roads and rail mostly. It's very pleasing that the Victorian government and at the same time the New South Wales and the Queensland and the South Australian government have all identified and stepped up their pipeline of commitments for social infrastructure projects, healthcare in particular. I think there were a few people caught a bit short during COVID and post-COVID. It's under immense strain, and so you see it in the pipeline. So I think the pipeline's probably looking about right now. Our chances of each of the states delivering each of their ambitious pipelines all at once is Buckley's. So especially if they all draw entirely on the state balance sheets, which are maxed out. So my hope is that the big investors, the really big balance sheets, they will keep their eye on the renewables and the energy transition. We must. They will keep their eye on some of the big nation-building projects, cyber security infrastructure, whatever that looks like, and some of the big national stuff. And then if we're smart and if people are a little bit bold and a little bit prepared to think differently, I reckon we can just about carve out the social infrastructure stuff and say this is perfect for partnerships. It's perfect for partners with operators and investors who've been working together for generations already, and government. And let's free up the procurement a little bit and encourage long-term partnerships and see if we can get it done in parallel and we get everything, our cake, and we eat it too. We're safe and we have a good environment and we have good services.
Sounds good.
Have you nice?
Peter?
It does sound good. I mean, I look after asset management for the Aussie assets, so I guess I tend to think, well, it's always the time to be looking at what you already have and you already own and how you can improve that and make those outcomes better. But the reality is the challenges that we have and governments, all Western governments have, interestingly, are huge, and there's going to be a lot of demand for private capital to meet those requirements. Renewables is the obvious one as we transition to a low carbon future, but it is worth noting there are a lot of other countries trying to do exactly what we're trying to do, and we're spending a little bit of time at the moment looking at this Inflation Reduction Act in the United States and how does that compare with what we're trying to do in Australia. And I don't think every country is going to be able to decarbonise in this period between now and 2050 as fast as we would like. Some of the incentives that other countries are offering are, pretty astronomical and do change the investment equation. We invest about $6 overseas as compared to every $1 invested in Australia at the moment. There's nothing right or wrong with that. It's just how we diversify the portfolio as our investors want. But I think it's not sort of simple necessarily as coming up with the ideal package of what the financial investor wants. Someone has to build this stuff, especially as we look into energy transition. And if that resources and those equipments are actually allocated off, somewhere else where there is a potential better outcome, that's going to potentially cause problems. And so we think what's happened in the last couple of years with far better oversight of the renewable energy market and a far better sort of pathway as to where we're going as compared with what we have is a great outcome. But how do we get private capital to get more involved in those sectors? It not only depends on what Australia is doing, but what the rest of the world wants to do as well.
Yeah, from the government perspective, I'd say that it's equally important to ensure that what is in the pipeline is being delivered, but also what the new investments being announced get carried out. What I say is that in government, as you know, resources are scarce. So just because the focus of or the priority of the government for this term is around healthcare and some other social infrastructure and less emphasis on transport, for example, and more emphasis on energy transition, doesn't mean that the demands have decreased in those other areas. So the key thing for us is about creating those partnerships that can look at both building new infrastructure and assets, but also, we call sweating the assets or making existing infrastructure, more fit for purpose and move with the time. So it is equally as important, either way for us.
I forgot to say this morning, we heard about the precinct concept around the new rail stations in Melbourne. That is a perfect example of a way to fit more through the pipe. If you instead of thinking asset by asset sequentially for the next 30 years, if you think precinct and you stand back and you aggregate the demand and you package into a program and with a precinct outcome in mind, I feel you get better procurement, better supply chain management, better contractor management, and more capacity through your pipeline in a heavily contested world for investment and capital and contractors. So that was really good to hear this morning, that that the current government is coming to those precincts knowing full well that they're probably retired by the time they're all delivered. So looking through election cycles, which is what you need to do with infrastructure, and combining it around a community outcome, designing for a community outcome rather than asset by asset. Really good to hear.
Thanks, Esther. Okay, we'll draw it to a close there. It's been a really interesting discussion. Certainly for me, it's highlighted in a very practical way a lot of the themes, as the one you just mentioned, that we've been discussing this morning. So thank you very much to the panel for your participation today. It's, as I said, it's been a great discussion.